On the 6th of May 1994, a British Queen and a French President opened a tunnel under the sea. It is still there. It still works. Last year, the company that owns it earned 320 million euros in profit. More than 537 million people have now traveled through it. Its concession runs to the year 2086. And the people who paid to build it lost almost everything they put in. More than 500,000 ordinary savers, roughly 2/3 of them French. Teachers, pensioners, people who bought a few £100 of shares because a government told them this was the future. This is not the story of a project that failed. This is the story of a project that succeeded completely and destroyed everyone who financed it. Britain and France had been drawing tunnels under the channel for nearly 200 years. Every scheme died the same way. Someone worked out what it would cost, and no government wanted to be the one holding the bill. Margaret Thatcher solved that problem with a single sentence. In 1987, Parliament passed the Channel Tunnel Act. Section 2 carries a heading you do not often see in infrastructure law. It reads, "No government funds or guarantees for the tunnel system." The concession agreement went further. The builders would proceed, in its words, at their own risk, without recourse to government funds or to government guarantees of a financial or commercial nature, and regardless of whatever hazards may be encountered. Regardless of whatever hazards may be encountered. Read that clause carefully, because it is the whole story in one line. It does not reduce the risk of digging a 50-kilometer tunnel under the sea. It does not make the geology softer or the forecasts truer. It moves the risk, it moves it off the state, which will own a functioning asset either way, and onto whoever is standing at the very back of the queue when the money runs out. In 1987, nobody knew who that would be. By 2007, everybody did. The concession went to a consortium. 10 construction companies and 5 banks. 5 British contractors and 2 British banks. 5 French contractors and 3 French banks. Those same 10 construction companies then formed the contractor that would build the tunnel. It was called Trans-Manche Link. So the 10 firms building the tunnel were, at the start, the majority owners of the company paying them to build it. The academic who documented this most carefully, Graham Winch, counted 4 of the 11 directors on Eurotunnel's joint board, who were simultaneously directors of the TML construction companies. He wrote that the conflict of interest was to dog the project for the next 8 years. Money came in 3 rounds. £45 million from the founders, 200 million from institutions in 1986, and then in November 1987 the public offering, £770 million at 350 pence a share. That offering opened weeks after Black Monday, the worst stock market crash since 1929. It barely got away. Total equity, about £1 billion. Against a syndicated loan facility of 5 billion. £5 of debt for every pound of equity on a project that would not earn a single pound of revenue for 7 years and would pay interest on that debt every day in between. The tunnel had not yet been dug. The outcome was already largely determined. Here is the part that went right. Under the English Channel there is a layer of stone called chalk marl. It is chalk with 30 to 40% clay in it. That mixture is close to perfect for a tunnel. Soft enough to cut, impermeable enough to keep the sea out, strong enough to stand up without heavy support. On the British side, that layer runs continuously, almost dry. 6 open boring machines drove through it at an average of 149 meters a week. On the French side, for the first 5 kilometers, the same rock is a different animal. Harder, fractured, full of water at pressures up to 10 bar. 5 French machines had to run closed, pushing back against the sea. 11 machines. 2 rail tunnels, with a smaller service tunnel driven ahead as a pilot. 50 kilometers of tunnel, 38 of them underwater. It remains the longest undersea section of any tunnel on Earth. On the 1st of December 1990, 40 meters below the seabed, A British miner and a French miner shook hands through a hole in the rock. Neither had been chosen. Both had been picked by lottery. 10 men died building it. Judge the engineering honestly. Construction costs, measured properly in constant 1985 prices, ran 80% over budget. For a first of its kind undersea tunnel in that decade, 80% is close to the average for mega projects of this size. The engineers did not sink this company. What sank it was written on paper years before the first machine turned. Eurotunnel did not sign one contract with Trans-Manche Link. It signed 3, each sharing risk differently. The terminals and the fit-out were lump sum, a fixed price. If it cost more, TML ate the difference. The tunneling ran on target cost. Come in under the target and TML kept 50% of the saving. Go over and TML paid 30% of the overrun, capped at 6% of the target. Look at that shape. Unlimited upside on savings. Capped downside on overruns. Then the rolling stock. The shuttle trains were procured on cost reimbursement plus a percentage fee. Every risk sat with Eurotunnel. A percentage fee means the contractor's payment is a slice of the final cost. The higher the cost, the larger the slice. Rolling stock costs soared. Winch's assessment is 1 sentence long. The percentage fee had proved a gold mine to TML. Be careful here. There is no evidence the construction firms got rich overall. They fought Eurotunnel for years, took write-downs, and watched their own shareholdings collapse. What the record does show is narrower and stranger. On one of the largest line items, the contractor's fee rose with the bill. On another, its share of any overrun was kept while its share of any saving was not. And 4 of the 11 directors approving those payments sat on the boards of the companies receiving them. TML eventually claimed £1.5 billion in extra costs. In 1992, an arbitration panel ordered Eurotunnel to pay TML £50 million a month. The order was overturned 6 months later. TML kept the $200 million already paid. They settled in April 1994, 1 month before the Queen cut the ribbon. Now the arithmetic that actually killed it. Construction overran by 80% in real terms. Financing costs overran by 140%. That second number is the one nobody puts on a thumbnail, and it is the one that mattered. Here is why. The tunnel was financed almost entirely with debt, and that debt began charging interest during construction, years before the first paying passenger. Every month of delay did not merely add a month of cost. It added a month of interest on everything spent so far, compounding on a balance that was itself growing. The tunnel opened roughly 12 months late. By then, the interest clock had been running for 7 years. In headline terms, the numbers you will see quoted are £4.7 billion becoming £9.5 billion. Roughly a doubling, but that doubling is not the 80%. It is measured in the money of the day, and it includes inflation and it includes the interest. 2 different overruns on 2 different clocks stacked on top of each other. Anyone who reports them as one number has counted the interest twice. The tunnel was finished. It was also on the day it opened carrying about £8 billion of debt. It now needed customers, a great many customers. The prospectus promised for the first year 15.9 million Eurostar passengers and 7.2 million tons of rail freight. In 1995, the first full year, Eurostar carried 2.9 million passengers. The freight trains 1.35 million tons. Under a fifth of the passenger forecast. Under a fifth of the freight. But the most interesting finding is not that the forecast was wrong, it is how it was wrong. The economist Ricard Angera went back through the numbers 12 years later. He found that Eurotunnel's forecast of its own market share was roughly correct. What was wrong was the size of the market. And the share it did win, it only won by fighting a price war. Read that again. It is the sentence that separates this project from a simple story of hubris. They were right about how much of the pie they would take. They were wrong about the pie. And to take their slice, they had to give away the price. 3 things arrived to take the price away. First, the ferries. The tunnel's 1-year delay handed them a year to renew their fleets. A ferry carried around 500 cars, a shuttle up to 180, and Les Shuttle launched at about £10 under a ferry ticket. Second, on the 1st of July 1999, the European Union abolished duty-free between member states. Ferries had been subsidizing cheap crossings with the profits from perfume and cigarettes. Onboard sales fell 44%. Eurotunnel's own retail lost around £50 million a year. Third, EasyJet was founded in 1995 and Ryanair was learning to scale. Eurotunnel won the market, and the market was worth far less than it had been sold for. In September 1995, 16 months after the opening, Eurotunnel stopped paying interest on its debt to avoid bankruptcy. For the year 1995, it reported a loss of £925 million. Be precise about what that number is. It is a net loss, driven overwhelmingly by interest on £8 billion of debt. The tunnel was not hemorrhaging money-moving trains. It was hemorrhaging money owing money. Then the tunnel started catching fire. November 1996. A lorry burns on a freight shuttle. Everyone gets out. The concrete lining, 40 centimeters thick, is burned down to 2 centimeters in places. Repairs cost around £200 million. From 1999 to 2002, a refugee camp at sank sat beside the French terminal. People climbed onto freight trains. Eurotunnel put its losses at around £5 million a month. September 2008, another fire. 60 million in repairs and roughly £185 million of lost revenue. Through all of it, the interest kept running. The share was issued at 350 pence. Within hours, it traded around 250. In June 1989, it touched nearly £8. Anyone who sold that month tripled their money. Almost nobody sold. By the end of the 1990s, the share was 71 pence. The restructurings came in waves. In 1998, the banks took 45.5% of the equity in exchange for writing off about £1 billion of debt. In the same negotiation, the governments extended the concession to the year 2086 and took 40% of future operating profits. In April 2004, the French small shareholders had had enough. Led by a financial publisher named Nicolas Miguet, they turned up at the annual meeting, voted out the chairman, and took control of the board. It changed nothing. The debt was the debt. On the 2nd of August 2006, the Commercial Court of Paris opened the procedure de sauvegarde. Debt stood at €9.073 billion. On the 15th of January 2007, the court approved the plan. The debt was cut by 54%. The existing shareholders, fully diluted, were left with about 13% of the new company. Everything they had built, they now owned an eighth of. There is a detail from those years that says more than any chart. The French small shareholders, having lost most of what they put in, began holding an annual dinner. At each one they gave an award. It went to whichever shareholder could prove they had bought their shares closest to the all-time high of 1989. They called it the dîner de cons, the dinner of fools. They were not fools. They were the only people in this story who took the risk they were told they were taking. Everyone else had moved there somewhere down the line. So follow the money to the end. The construction firms were paid to build. Their shares became almost worthless, and they fought Eurotunnel in arbitration for years. On the record, they neither triumphed nor were wiped out. The senior banks were paid in full in the 1998 restructuring. Junior creditors, bondholders and shareholders took the losses. As the debt cheapened, distressed funds bought the claims from the banks at a discount, then converted them into equity in 2007. Goldman Sachs ended up with 15% of the company. In 2018, it sold that block for roughly €1 billion. The two governments spent nothing on construction by law, and today hold a claim on 40% of the operating profits of a tunnel that will still be theirs in 2086. And the savers, more than 500,000 of them. Their stake was diluted to a half, then to an eighth, then diluted again by convertible notes. The most cited estimate of their loss is about 99%. That number is an estimate, not an audited figure. The order of magnitude is not in doubt. Bent Fleifbjerg calculated that the whole project represented a net loss to the British economy of $17.8 billion. That is his calculation, and it is contested. Today the tunnel is owned by a company called Getlink. In 2025 it made just under 1.6 billion euros of revenue and 320 million of net profit. It is worth about 10 billion euros. Its car shuttles carry roughly 55% of the traffic on the short straits, and about a quarter of all trade between Britain and the continent goes through it. The tunnel is one of the great engineering achievements of the 20th century, and it is a good business. It only had to destroy its owners twice to get here. The phrase "no public money" sounds like a promise of discipline. It is not. It is a statement about the order of a queue. The state took no construction risk and kept the asset. The contractors were paid to build. The senior lenders were made whole. The funds that arrived late bought the wreckage cheaply and owned the recovery. And at the back of the queue stood a school teacher in Lille with 300 pounds of shares, holding what was left after everyone ahead of her had been paid. What was left was negative. Every mega-project prospectus is a forecast wearing the clothes of a fact. The Channel Tunnel told the truth about the rock. It was wrong about the market, and it was silent about the queue. Next time on Paper Empires, a satellite network that cost $5 billion, went bankrupt 9 months after launch, was sold for 25 million and is still flying over your head right now.